If I could have your attention. Thank you, friends. Our bylaws require that we take care of a little club business before we begin the evening's program. Let me introduce the chairman of the nominating committee, Peter O'Malley.
Mr. Chairman, thank you very much. Our nominating committee has done its usual splendid job. We have available in the back of the room the Virginia Board of Election Supervisors. They're prepared to accredit the group that we're going to nominate if you see fit to elect them. As you know, the club's board of directors consists of 26 members. 8 of these have completed their second 3-year term. In accordance with our bylaws, they are stepping down from the board. The departing board members are Terry Newmeyer, David Lambert, Steve Harlan, Dan Callahan, Jerry Hawk, Doug McCorkindale, Harry McPherson, and a vacancy created earlier when Bill Hodges moved to Charlotte last year. Would you join me in a round of applause recognizing their hard work on our behalf? The good news is that replacing Harry McPherson and Terry Newmeyer on the board of directors does not affect their terms as officers of the club. So there is less urgency to have the Board of Elections convene in the back of the room. We have a very capable slate. The nominating committee recommends that the following persons be elected as new members of the board: Anthony Mazzelli, Gene Conley, John Derrick, DeLon Hampton, Ray LaPlaca, Barbara Reinecke, and Susan Williams. Mr. President, I move approval of the slate of directors put forward by the nominating committee.
Is there a second? All those in favor, let it be known by saying aye. All those opposed, thank you. The slate is elected. Ladies and gentlemen, we have 2 special guests from the diplomatic community with us tonight. The Ambassador of Belgium, His Excellency Andre Adam, and the Ambassador of Italy, His Excellency Ferdinando Saleo. Would you give them a round of applause? Thank you, gentlemen. Welcome, Mr. Ambassador. We're delighted to have you. Let me review our format. After Mr. Grasso's presentation, I'll moderate the question and answer period. There are cards at your table. Please write legibly and get them up here to me, and I'll put them to Mr. Grasso. Dick Grasso is beginning his 30th year with the New York Stock Exchange. He joined it in 1968, and he has had a broad range of assignments ever since then. He was elected chairman and chief executive officer in 1995. For the previous 7 years, he had been president and chief operating officer. He is the first staff member. Now, I want to hear a little applause from anybody who's ever been a staff man. He's the first staff member in the 205 years of the New York Stock Exchange to be elected to any of the exchange's top leadership positions, and he is the chairman. He is committed to maintaining the exchange's preeminence in the global equities market. He was talking to me at dinner about the size of this market, and maybe he'll have a chance to give you that number as he speaks this evening about the amount, the dollar amounts that are involved in the New York Stock Exchange. It's staggering to anybody, even somebody who's worked in the government for a while. He is a member of the Board of Directors of Computer Associates International. He's a member of the International Capital Markets Advisory Committee for the Fed, and he serves on the Board of Directors of the National Italian American Foundation, the Police Foundation, the Board of, and the Advisory Board of the Yale School of Organization and Management. He's also an extremely nice guy, as I have learned. It gives me great pleasure to welcome to the Economic Club of Washington the chairman of the New York Stock Exchange, Richard Grasso.
Thank you very much, Harry. Good evening, ladies and gentlemen. Those very warm remarks are deeply appreciated on behalf of all staff members everywhere. I'm deeply honored to be with you this evening. I want to thank the board of the Economic Club. I particularly want to thank my partner, David Lambert, outgoing board member. There are so many members of the New York Stock Exchange extended family here tonight that I know I'll get myself in deep trouble if I start naming names. But suffice to say, so many of our listed companies, our member broker-dealers, and those that have been enormously important to the success of our great institution are here tonight, and I thank you for taking time out. I will, however, depart and offer one very special acknowledgement. It was about 22 years ago that I started working on a particular account. Having been at the exchange since 1968, I was finally given an assignment. It was to try and do something important, list a new company. And of course, being a rookie of some 3 or 4 years, I did all that I could to foil the business from joining us. But it was Ed Kolodny, who is here tonight, who rescued me. And Ed, I want to thank you for being such a great friend to a young intern, because that was a very important part of my early career at the exchange, the listing of Allegheny. And I truly thank you for being a friend for better than 20 years, and your sponsorship and guidance at that time was very important to me. I'm delighted, Ed. I'm delighted to be here because this is a time of extraordinary challenge for those of us in markets, and particularly in a town like this one, where if there is a constancy, it is change. I am deeply honored to be invited to this club, and most humbled to have been introduced by Harry, because, of course, you know him better than I at the club, but for the better part of 4 decades, he's been advisor to presidents and to opinion leaders, and it is for me a very special honor that you would introduce me tonight, Harry, and I thank you for that. It is a time of unprecedented opportunity and yet great challenge and great questioning in markets today. The New York Stock Exchange finished last year as the most active in its history. Some 133 billion shares having changed hands on the big board. That would be 100 times the first full year of my experience at the NYSE. And as Harry mentioned in the introduction, I did indeed join the New York Stock Exchange in the 20th century. In a period of some 30 years, we've gone from a marketplace with a valuation of less than $1 trillion to one that today approaches $12 trillion. But more importantly than the scale and size of the New York Stock Exchange is the breadth and participation that we enjoy in this country of the American population's involvement in the marketplace. Truly today, some 60 million Americans are direct participants in our markets, and when one looks to the indirect participation, almost 200 million Americans are impacted by what happens on the floor of the New York Stock Exchange each day. That is a very special honor and privilege. It takes a command responsibility of serving the largest and the smallest with the same level of care and oversight. It is a marketplace that in May of this year will celebrate its 206th anniversary, and yet it is a marketplace that 10 years ago did not have the privilege of trading 2,000 of the 3,000 companies that we are today privileged to trade. So we are almost as old as this great nation itself, and yet as young as the newest IPO to join our ranks. We are a marketplace that increasingly is seeing the effect of globalization. And that is the subject I'd like to touch upon this evening. Globalization and the interconnects that exist between markets and economies all over the world. 1997 was a benchmark year for the securities industry and for investors in this country. The third year of 20-plus rates of return on the Dow Jones Industrial Average and greater rates of return on some of the broader averages. It was for the New York Stock Exchange a year in which we listed a record number of non-U.S. companies. That non-U.S. record, as proud as we are of it, is simply a forerunner of what we expect the years ahead to produce. And yet, given what has happened, and particularly in the fourth quarter of last year, what happened in the markets in Asia, there are many that are asking the question, are we going in the wrong direction? Is globalization the wrong strategy? Is this interconnected nature of markets and economies going to produce some evil? As you might expect from me, the short answer is emphatically no. I believe that the benefits of globalization, the benefits of interconnect, far outweigh the challenges and the downsides that indeed we've experienced late last year. It is important, I think, to put the challenge of globalization into context. Globalization is a social and political interconnect. It is beyond economics and finance, and we believe, and certainly economies and those representing countries from all over the world who visit share this view, that it is largely and thankfully the result of globalization and interconnected markets that we today worry about, not the loss of lives, but the loss of dollars. Clearly, there are enormous risks inherent in maturing, emerging, and pre-emerging markets. But is that not a much better position to be in? Concern about volatility and currencies than the movement of troops. Is that not a unique opportunity as we look at America today with virtually no alternative economic model anywhere, a unique moment in our history? The disciplines of the free market process, equity, ownership, being the tool that will fuel the growth of companies and countries, that will bring peace, as distinguished from centrally managed, debt-driven economies of alternative economic directions that not too many years ago brought peril to world order. This is a unique time, and a time yet, having experienced the delight of the latter part of October, and I must say, in all candor, that October of 1997 was very different than October of 1987, and yet equally dark on the 27th, when investors saw the Dow Jones Industrial Average fall some 354 points on what was to that point the most active day in our history, and yet a day later, 1.2 billion shares change hands on the New York Stock Exchange, and the market rallies some 350-plus points. It defined for us a moment to reflect and to look upon the opportunities that globalization are presenting. Clearly, there are questions to be raised for those markets, and particularly those economies that have let their growth and their flow of funds outstrip their ability to oversee and discipline both the public and private sectors. But that's not a reason to abandon this process that started just 2 decades ago with the beginnings of privatization coming from the Thatcher government rolling around the world, Europe, Latin America, Asia. We find ourselves today at a unique moment, clearly a moment when we must pause to reflect. The reflection, I think, that we need to take in terms of what has happened in the Pacific Rim can gain some insight by looking at the experiences we had just a few short years ago with our neighbor to the south, and how fortunate we were to have had, at the moment of crisis in the Mexican economy, to have had the leadership at the Treasury from Bob Rubin, with the support of the Congress, to bring about structural reform and to return that economy to a path of sustainable growth with low inflation, with the proper incentives built to channel capital at rates that were realistic. And indeed, we gained some insight as to how we must act when other parts of the world, trading partners to this great nation, are challenged by some of the same very significant structural damages. Globalization, though, should not be looked upon as having passed. It's accelerating. The globalization trend, if one were to look simply at a period of 10 years, 1988, 40 programs worldwide raise about $42 billion. 10 years later, double the number of programs and almost $100 billion. And that is still an embryonic level when one considers the prospects that are out there. At the New York Stock Exchange, using a very narrow lens, if I were to size for this audience the opportunity in the global theater and compare it to our domestic opportunity, I suspect there would be great surprise. In America today, or at least at the end of last month, there were fewer than 750 domestic corporations, publicly traded, qualified to be on the New York Stock Exchange that were traded elsewhere. If we were to fully tap that market opportunity, bring every one of those companies to our market tomorrow, trust me, ladies and gentlemen, we would be delighted to experience that sudden rush of demand upon our capabilities. If we were to do that, we would add $1 trillion of value to the New York Stock Exchange. Outside of the United States, the picture is quite different. Again, at the end of last month, we measure and estimate that approximately 2,700 non-U.S. companies meet the quantitative tests for listing on the New York Stock Exchange. The top 1/3 of that audience of opportunity, were it to join the New York Stock Exchange ranks, would add almost $7 trillion to our marketplace. And those numbers are before the privatization effect. The privatization effect, of course, is an estimate at best, and most times the estimate is quite far from reality. But again, through a very narrow lens, if you were to look at the experience with Deutsche Telekom, November of 1996, when Deutsche Telekom listed on the New York Stock Exchange, its value was the equivalent of 6% of the then domestic opportunity for the New York Stock Exchange's ranks. I use those numbers to underscore the enormity of opportunities that exist, not just for the New York Stock Exchange, but for American investors. American investors continue, notwithstanding this level of challenge that we experienced in the second half of 1997, American investors continue to be aggressive in the pursuit of diversification to the worldwide theater of economies that are emerging, existing, and some in the pre-emerging state. If you were to look, as we've measured amongst our broker-dealer organizations at the trend line, you found that last year the level of individual investor participation in non-U.S. securities grew to about 10% of the portfolio's composition. That number, most experts agree, will double in the next 7 years. It will double at a time when issuers from around the globe increasingly will seek capital outside of their domestic markets. And thus, the excitement at the NYSE. We finished 1997 with a record number of non-U.S. companies. Record number joined us last year, and we ended at 343, which would have been almost 4 times the level of 7 years ago. And yet, my partners and I believe that 3 years from now, the number will be double. The level of trading activity on the NYSE, each day last year, some 526 million shares changed hands. Roughly 10% of that activity was based or contributed from non-U.S. securities. That, too, is a number that is disproportionately small. And again, the lens, the narrow lens of the NYSE offers some insight as to the prospects that lie ahead. If one were to look at 1994 and 1995 as a bench, the most actively traded security on our marketplace for both of those years was not an American company. It was the Telephone Company of Mexico. Amongst the 5 most actively traded last year from a dollar volume standpoint, Telebras, the Brazilian telephone company. And I think it is a very important indicator to those in markets, to those in public policy, and certainly to those in the investor community of the dynamism that was started some 20 years ago. We are in a period right now of unprecedented returns, given the last 3 years, enormous questions being raised as to the desirability of the interconnected nature of markets, and yet at a time when, ladies and gentlemen, I offer at least a personal view that this is not a process that you want to reverse. This is a process that we must stabilize and accelerate. If you were to look at the wonderful leadership I think that this administration has brought to the problems, they have offered very, very significant reforms requisite to the programs of assistance. And I believe that is going to offer to those countries most in need of our help the right solution. If you were to look at the initiatives from the private sector, we at the New York Stock Exchange have offered all markets, emerging, pre-emerging, and those that are repositioning, the opportunity to come to the NYSE and learn our process, clone our technology if they choose, but most importantly, embrace our system of regulatory oversight, because the system here in this country, I believe, has contributed to the success and depth and breadth of participation that we today enjoy. The partnership between the markets, the regulators that oversee markets, and of course the Congress has built a model that is truly the envy of the rest of the world. Looking at the NYSE through the lens of what happened last October, I think is a very important forecaster of what we might expect in the years ahead. The week ending the 31st of October was an important one from a number of different perspectives for us. It was the first time in our history that 4 billion shares changed hands in a single week, the first time that 1 billion shares traded in a single day, and of course, the first time in the history of markets, I believe anywhere, that the president of China would ring the opening bell. It was, though, more than symbolic. It was a visit of great importance, not just to those in markets, but I believe to all Americans, a signal that there is going to be reform in the PRC. There is going to be an embracement of the principles and disciplines of the free market process, and we have offered our collective expertise of the securities industry that I so proudly represent to try and help that government get to the structural reforms that can lead to the proper economic incentives that will ultimately, I believe, be important to the contributing successes that will be sought in the areas of social reform. As we look through the lens of October of 1997, we at the New York Stock Exchange have some work to do. The most active week in our history, the most active day in our history, a test and a real live test for our capacity and the sturdiness of our process. I'm proud to say that we did indeed make the proper investments over the last 7 years in technology, which enabled us to handle that 1.2 billion shares on the 28th without flaw. Indeed, at no time that day were we above 47% utilization of our technology base, something that I think was important, but it equally was important for us, the operators of the market, to recognize that we have work to do, because if we can trade 1.2 billion shares in a single session, it is not going to be very long before 1.2 billion shares will be an average day. And if 1.2 billion shares becomes an average day, then clearly we will see peak days well in excess of 3 billion shares. And indeed, we are planning for that. Today, we have the capacity to handle almost 3 billion shares. This time next year, I'm hopeful that will be up somewhere between 4 and 5. 2.5 to 3 years from now, comfortably in excess of 6 billion shares. And I believe that will be the challenge that our marketplace will face. It will be faced with that challenge based on broadened participation here in the U.S., more and more investors coming into the market as Americans take charge of their finances, understand that they've got to save and invest, and indeed, as international issuers recognize that a pool of capital, the largest and deepest in the world, awaits those companies that are prepared to meet the rigors of a registration in the United States and the disciplines of transparency and governance that U.S. investors have come to appreciate and indeed have come to expect. We are in a period where emerging markets are maturing. I would hope that the experience of last October tells us one thing. In any sharp growth cycle, there will be corrections. It is important, again, to look at history. 32 years ago, the Dow Jones Industrial Average crossed 1,000 for the first time since its creation back in 1896. What few people remember is coincident with the Dow at 1,000, so too was the Nikkei 225. In the period 1966 through 1989, we watched the Dow go from 1,000 to 2,700, back to 1,600, and then marginally above 2,000. In that same time frame, we watched the Nikkei go from 1,000 to 38,000, back to 12,000, and now to its current level of some 15,000. Again, I think a very important reminder that markets do not simply go in one direction, but that long-term investment, certainly if you were to take a time horizon of greater than 7 years, the typical investor in that 7-year time horizon has been handsomely rewarded with a premium being in the equities market over the fixed income alternative. We today at the NYSE find ourselves in a period of growth beyond even those who are closest to the institution's wildest expectations. Again, history is an important foreteller of what's in front. It took the New York Stock Exchange from its founding in 1792 until 1977, a period of 185 years, to list 25 billion shares. In the last 25 years, 20 years, since the spring of 1977, we've watched that 25 billion shares grow to more than 200 billion shares. We are a marketplace that has never been larger, either as to its capitalization, the number of investors who participate each day in the price discovery process, and the number of great companies that we're privileged to trade. And yet, there's a common denominator that traces to our founding, and that is each day, in each transaction, what we do through the lens of the least sophisticated user of the market. If we can protect that user, if we can say to that small consumer, you, the investor for 100 shares, have been treated as fairly and have had the same opportunity to capture a transaction, be it a sale or a purchase, as the largest institutional user of our market, we will have served our mission. But more importantly, we will have reinforced the public's confidence in the marketplace here in the United States. We are so fortunate in the U.S. to have built a model, a listed model and a dealer model that serve our base of great companies so well. We are in a time frame when those who would question the market, both from an interconnected globalization standpoint and from a performance standpoint, can easily find company. And yet I would say it is important to recognize that those with long vision have been truly rewarded by their patience and their due diligence. It is not unlike the questions I'm sure that were asked about the U.S. some 150 years ago, when it would have been easy to look at what was happening here in the United States and question the viability of this model. It is important, and I believe imperative upon all in both the public and private sector to support with conviction the initiatives that are coming from the administration set of initiatives designed to bring about structural reform in some of the emerging companies and countries that are suffering. And yet, it is equally important that we not abandon this model. If you were to look at the great American companies, the 5 largest that I'm privileged to trade on my exchange, you would find that on average they earn more than half of their revenues outside of the United States. Consumer market opportunities are broadening. The opportunity for cross-border transactions never larger. Last year, $500 billion on the NYSE in non-U.S. securities, more than $2.2 trillion of trade in the cross-border global sense. It is a time of unprecedented size for markets, huge challenges for those who oversee markets, and yet a time when I believe we in the business community must support this, I believe, very positive, affirmative role that we've played at the administration in terms of bringing about the proper levels of change that must take place. Markets have a history, a well-defined long history of overreacting. But it is also well known that in overreaction comes opportunity. And opportunity is observed by smart investors. I believe those, many in this audience, who can see the course and who can look above this current valley will be handsomely rewarded, because markets, in my view, will grow in their interconnect, in their mutual dependency, and that will be good, not just for the business of business, but for the world. Thank you very much for having me here tonight.
Thank you, Dick. I was about to ask if all smart investors would please stand out there. We'll get on with our questions. Dick, people on the East Coast who get up at a reasonably early hour have been waking up to reports of what happened overnight in Hong Kong and Tokyo in the stock markets, and what happened during the morning in the European markets. Do you worry about the contagion effect that reports from far-flung markets can have on the American markets?
Well, the answer is clearly yes, as evidenced by the fact that in my role today, it's probably wise not to go to sleep. But in reality, while there is clearly a wave that can communicate, best evidence of that, 27 October of last year, it started in Asia, moved to Europe, and then, of course, we had our 554-point down day. There clearly is an interconnected factor. I think markets have become smart enough to recognize and to differentiate economies, companies within respective economies. And so while there can be a crowding, while there can be a herding effect, I suspect the answer lies better in the 28th than in the 27th, because investor rationale returns to markets that right themselves. And there are those who believe that a difference of a day can be an extraordinary difference. Those who question that look at, if you will, the sentimental change between the close of business on the 27th and mid-morning on the 28th. There is clearly an interconnect effect. It clearly will impact, but I believe markets, and particularly investors today in this market, are smarter than ever before and do the due diligence of differentiation.
This is a question I think a whole bunch of people here will have an interest in, and maybe a lot of opinions about. How do you feel about the use of circuit breakers in the market, and do you foresee any changes in that in the near term?
Well, as I've said publicly right at the time of the October event, the circuit breakers that are in place today need to be reformed, but I do believe in the final analysis that some form of timeout, some level of market downside experience should cause us to take a breather. The current breakers are A, too low, and B, too narrowly defined. At our upcoming board meeting, we will discuss a series of initiatives designed to change the breakers, but I do believe it is important, particularly for the retail consumer, to have a timeout, to have the ability to step back and say, this market has had a dramatic downturn. Does it make any sense? Should I not do what I'm about to do? And I believe there is a general feeling amongst individual investors that that is a wise course to pursue. But clearly the point levels that we currently have in place are non-reflective of the size of the market. Recognize, as I know most in this audience do, that they were established on a very different base years ago. Number one, the new breakers will be percentage-based. They will be considerably higher than the current levels, and there will be bandwidth between the first level and any multiple level thereafter.
Thank you. What impact will the discount internet brokerage businesses have on more traditional, larger brokerage houses? Markets, I mean.
Well, the deployment of the internet, or the so-called electronic trading alternative broker-dealers, is having an impact on virtually every part of the brokerage community, so much so that many are now splitting their own brands into a discount brand and an internet brand. I believe what's very clear is that there is a consumer base out there that does not want the traditional services offered by intermediation. However, that is a relatively small universe today. It's I believe, incumbent upon those intermediaries to recognize the differences in customer attitudes, and many are already recognizing that by the introduction of what they'll term their broker-dealer light alternatives, home access to the network of a particular firm, interconnect capabilities, and by the way, some have gone to the extent of driving that right down to the marketplace level. Today, if one were to call a broker-dealer member of the New York Stock Exchange and offer an order to buy or sell less than 2,000 shares of any listed security, that transaction from your broker's desk will be emailed to the floor of the exchange, introduced to the price discovery process, executed, and back on your broker's terminal in 22 seconds. On an average day in 1998, roughly 81% of my trades, producing 40% of my volume, are handled in the manner I've just described. So technology becomes an enabler. It doesn't necessarily displace. What it creates is a competitive tool for those who deploy it effectively.
22 seconds. Dick, as markets become more global and active, what are the prospects and plans for the New York market to remain open for 24 hours?
Well, Harry, that'll certainly solve our problem of having to wake up to a market report from elsewhere. I think it's very important to recognize that we are still a relatively embryonic international market. 10% of our companies are non-U.S. companies, approximately 10% of our daily activity being generated by those companies, heavily concentrated in the Latin American security base. But there is clearly going to come a time when the mix of trading on the New York Stock Exchange and the types of companies traded will be more heavily weighted to the world's market rather than to the domestic market. And I say that in the sense that as we look at the last 10 years, capital markets, or the equity portion of capital markets, have grown from 9 trillion to 22 trillion worldwide. I believe that the hours a marketplace will operate from will be a function of the mix of investors, the mix of issuers, and the contribution of trading volume. It is clear to me, 24 hours may stretch it a bit, Harry, but there will come a time in the next 5 to 7 years when I wouldn't be surprised that the New York would be a 16 to 20 hour a day market, that we would be trading in currencies other than the U.S. dollar, and that non-U.S. securities would trade as they do today in the American deposit format and in the ordinary format. That would give us a market model which would allow institutions from around the world, as well as the least sophisticated retail consumer from right here in the U.S., to participate on an equal footing. I don't, however, look forward to a 24-hour market, and I'll tell you very simply because there is a need to pause for valuation, clearance, comparison, and settlement, and most importantly, for a little bit of sleep.
Yes. How are you fixed? How is the exchange fixed for the year 2000? How are your computer systems fixed for that?
Well, fortunately, since we only commenced building the infrastructure some 22 years ago, most of it is either converted to Y2K compliant or never had the same types of problems that some of the older infrastructures in the broader community have. It's not sufficient, though, for me to say the New York Stock Exchange is prepared and ready for the stroke of midnight, 1999's passing into the next millennium. I've got 560 broker-dealer members who must also be able to service and interconnect with me. They've got 10,000 institutional customers. I'm building, of course, the scenario that most are familiar with. This is an interconnected problem of financial services to the broader and virtually the entire spectrum of commerce here in the U.S., and we can't stop it right there. The year 2000 indeed will happen in parts other than the United States. And so it is a worldwide issue that I must tell you in all candor, no matter how well prepared we as a single participant may be, it is those who interface with us that we've got to be certain are compliant. Our broker-dealers are going to be working with us this year to make certain that they are indeed compliant, and we are working with other agencies to make certain banks, insurance companies, at least the financial sector as we define the overseen marketplace, is prepared. But I will tell you in candor again, Harry, on the stroke of midnight, December 31st, 1999, I will not be in an elevator.
Well, ladies and gentlemen, I think we've all had a good demonstration of why Dick Grasso rose from being a runner in the New York Stock Exchange to being its chairman. And we want to thank you very much, Dick, for an extremely enlightening talk by a very serious person who is managing the well-being of an awful lot of Americans and people all around the world. And as a tribute to you, and for you to take back to New York, the Economic Club would like you to have this American Eagle from the Steuben collection as our tribute to you and our thanks to you for an excellent talk. And thanks so much, Richard Grasso.
Thank you, John.
It was a real pleasure.
Thank you all very much. Harry, I thank you, the board, and everyone in attendance for this wonderful opportunity. And to my children who are up beyond their bed hour, please go to sleep. Thank you very much.
Great.